Real estate versus stock market. Which makes more money? Asterisk real estate versus stock market. Pros and cons. Welcome to another video. Today, we discuss the pros and cons of the real estate sector and the stock market. We will provide comprehensive information to guide your investment decisions and help you generate significant wealth. Let's begin. Asterisk stock market pros and cons. Asterisk pros. Asterisk 1. Liquidity. Accessing money invested in the stock market is easier compared to other forms of investment, such as real estate. This allows you to trade, sell, or buy based on your preferences at any given time. This flexibility enables you to access your funds quickly when needed without waiting for a long period. The investor or stock owner can continue to invest in other areas according to their usual plans. You can also liquidate your stocks quickly if you anticipate negative market changes to avoid losses. 2. Potential for high returns. When you understand the stock market well, you can monitor the performance of various stocks and make substantial profits. You can also use experts to ensure you buy the right stocks that show a tendency to grow quickly based on market changes and trends. Using the correct tactics can make you rich overnight. However, it is crucial to be cautious and understand the risks involved before investing in stocks. 3. Investment capital. When investing in the stock market, you do not need to start with a large amount of money. You can start small and grow your portfolio according to the availability of funds. You can choose to buy low-value stocks but purchase many with the hope that their value will increase over time. This is beneficial for long-term investments where you are not in a hurry to liquidate. 4. Increasing share ownership. By continuously investing in a stock, you can end up owning a significant share in the companies you invest in. It is known that investors have bought companies by consistently investing in their stocks over a long period and increasing their shareholding. 5. Diverse earning methods. In the stock market, there are various ways investors realize their gains. One way is through the increase in stock value, which you enjoy when you sell and make profits. Another way is through dividends, which are normally paid annually. However, this depends on whether the companies make profits or not. Cons. 1. Stock market crash. Due to the volatile nature of the stock market, there is always the possibility that stocks can lose value in a very short time, which can have devastating effects on the investor. Once a market crash occurs, it may take time, even years, to recover, depending on the reason for the crash. It is important to keep this in mind as a potential investor. 2. Market volatility. The stock market can sometimes be very volatile, and investors can lose or gain. Keeping this in mind, it is advisable not to put all your eggs in one basket but to diversify the risk. You can create a portfolio that ensures you are protected from the inevitable market fluctuations. 3. Poor or no dividend payments. It is known that investors have faced disappointments when the stocks they invested in did not issue any dividends. This primarily depends on the performance of such stocks in the market. Poor performance will result in poor or no dividends, and vice versa. Some companies may also decide to withhold dividend payments and channel them towards development projects within the organization. Without control over the performance of the stocks, you can buy stocks from various companies thinking you have some influence over how the companies operate. This may not always be the case, as most decisions made regarding the management of the companies may not be known to all shareholders. Only the most important decisions made during the annual general meeting are open to shareholders and sometimes to those who own a large share of the company. 4. Long-term investments. The stock market works best for long-term investors. This is for those who are ready to wait for their stocks to increase in value before selling them. However, for short-term investors who need short-term gains, this may not be beneficial if they buy stocks or securities during a downturn or immediately after. They risk having to wait a long time for the value to increase to a level where they can sell and make good profits. 5. Time-consuming. When you decide to invest in stocks, it is not always a walk in the park. You need to do a lot of research and understand which stocks are performing well at the moment and in the long term to arrive at a profitable stock. You also need to conduct an investment analysis to guide you. After deciding which stocks to buy and completing the purchase process, you must constantly monitor their performance to know when to sell and exit when you observe carefully. You will be able to tell if you bought poor performing stocks and will not be caught off guard if things go wrong. Real estate pros and cons. Pros. 1. Control. When it comes to real estate, you have more control over your investment compared to other forms of investment, such as stocks. The investor has control and is able to manage their property without having to wait for others to make decisions for them. This makes the decision-making process easy, and you are able to seize any opportunity that presents itself without procrastinating. You have control and can develop strategies and steer your business in the direction you want to take. 2. Leverage. Real estate can be used as leverage to achieve your wealth faster and also develop your real estate empire. This can be used as a tool to minimize risks in your path to increasing your assets. You are able to use borrowed money in the form of loans to increase or grow the return on your investment. Financial leverage offers a crucial advantage to those who invest in real estate as well as potential investors and can help you grow in the real estate market. 3. Property value increases over time. In the vast majority of cases, the value of real estate increases or appreciates over time. However, we cannot forget the cases where you might buy a property in the wrong place or where it is negatively affected by events beyond your control. Nevertheless, with adequate research, you can identify a good property that will grow over time. Another beauty of property is that you can make modifications and increase its value, putting it in a position where it can earn you more when sold. 4. Provides income stream. If you decide to invest in rental properties, you are assured of a periodic income stream, whether it is monthly, quarterly, or annually. This can allow you to explore more opportunities in the real estate market and increase your value. The rental income gives you the freedom to pursue other activities as it does not tie you down even when you manage it. It is one of the best forms of passive income. 5. Grow your net worth. The rental income can be used to pay off any debt you have on your property. If you took out a loan to purchase a property that you rent out to tenants, you can use the earnings to pay off the loan and continue to make money for maintenance. A well-managed property is able to grow your net worth without you having to spend anything out of pocket. At the end of the day, you will be the owner of the property without any debt, and all the returns will come to you to invest eventually in more areas of your interest. In this way, you increase your net worth and your wealth. 6. Protection against inflation. It is known that when the value of money decreases, the resulting effect is that prices take an upward trend. The rate of inflation affects the value of most investments. The purchasing power of money decreases or increases depending on the rate of inflation. The good thing is that real estate investments are able to keep pace with inflation. In fact, inflation normally pushes the value of the property upward, making it profitable when sold a few years later. For those who rent or renew the lease agreement every year, they have the opportunity to increase their rents upward to counter inflation. Cons. 1. Low liquidity. If your intention is to buy and sell and make quick profits, real estate investments might not be for you. This is because some properties are not easily sellable and may take months or even years to find a good buyer. When investing in real estate, it is better when you focus on the long term. If your intention is to turn your money around quickly when you intend to sell your property quickly, you might end up selling at lower prices, making you lose substantially. 2. Creates liabilities. You cannot compare real estate to a loaf of bread. When you invest in properties, you end up with many legal and financial responsibilities. The management of the property, the rent or lease, as well as the maintenance, add to the responsibility. There is always an annoying risk that you might lose the profits and income that your property brings, especially in rentals where tenants might decide not to pay for some reason, such as financial difficulties. It is not uncommon for tenants to damage the property and not maintain it well. 3. High transaction costs. Compared to other forms of investment, such as stocks, the transaction costs involved in real estate are high. Normally, a huge capital is involved when purchasing a property, and since most taxes and costs are calculated as a percentage, you end up with a high cost for each transaction made. Investors need to be aware of this to ensure they have adequate capital to cover all the costs involved in their purchase. 4. Property management and maintenance. When you own a property, it becomes your responsibility to manage it well and ensure it is completely maintained, not only to attract clients but also to avoid enormous management and repair costs. Damage to the property by tenants can result in high maintenance costs and reduce the value of the property. If part of the property is not occupied, it does not exempt you from incurring some maintenance costs because, in that case, you spend money on the property but do not get income, which results in a loss. Hiring managers to manage your property if you cannot do it yourself is costly, and the management fee will erode your profits. 5. Competition. This can happen when your property is located among others in a highly competitive area. New properties are always coming up with more improved and updated structures. What is likely to happen in such a case is that the market will push tenants to jump from one property to another, which can result in losses due to vacant properties, especially if you do not constantly update the property. Consumers will always focus on where they can get value for their money, hence the need to always be a step ahead. We are interested in discovering your personal experience on the topic. Write it in the comments and feel free to ask any questions, we will be happy to interact. Feel free to leave a comment so that we can improve the content. Your like would be the cherry on top, and click subscribe to stay informed about upcoming publications.